But Ken, just to be clear, so you think that if you're a Walmart, you can pass on these, costs going up to your consumer without a bite back when inflation is already up and everything else they buy?
Look, if you're Walmart, you just saw Target's numbers yesterday, and you're going, yes, I'm going to be in a position to put cost increases through, because both these firms have to. I mean, the bottom line is they're not in a position to absorb the entire supply chain shock themselves. They're going to be putting price increases through.
And the consumer can take that?
The consumer, let's be clear, take it. I'm not sure what that means. For a family that's in the lower quartile of income, this is a really tough situation, okay? They're going to have to make some pretty painful decisions in terms of consumption trade-offs. I mean, this is why productivity growth is so important. This is why the right policies out of Washington are so important, because inflation really impacts people who are living paycheck to paycheck most aggressively.
So in the next quarter, I mean, are we looking at stagflation? And again, what does that do to the S&P 500? When do we hit bottom?
Well, I don't think we're not stagflation yet. Okay. Yes, GDP growth in Q1 was a disappointment, but we're going to see positive growth over the next couple of quarters. I mean, let's take a huge step back. Unemployment is 3.6%. There are 11 million open jobs. These are numbers that look nothing like gloom and doom.
But so what are we living through?
We are living through a shortage of workers, and we are living through a change in the policies of globalization that defined most of our adult lives. So with the workforce, we're the American workers. We still have fewer people employed today than we did before the pandemic started. We should have several million more Americans working. And we need those people working because that's how we satisfy the demands of the American consumer. And then for our entire adult lives, we've lived, by and large, and this is an uneven set of benefits, but we've lived through the benefits of globalization, which has been incredibly impactful in reducing the cost of goods. Now, we know some of the impacts this has had on towns with single manufacturing businesses that have been shut down and destroyed by offshoring. But as we roll back globalization, as we go to more insourcing, we're going to see that huge benefit of trade dissipate, which has been so helpful in containing inflation rates.
But so that's going to be inflationary.
That's inflationary.
And what does that mean for the markets?
So again, you've got these two inflationary problems. You've got a shortage of people in the workforce. You've got this impact of deglobalization that causes this inflationary environment that we're in. That's going to cause the Fed to have to raise rates. And at some point, we're going to go from a negative real rate environment to a positive real rate environment. And the stock market is seeing that play out. They're forecasting that, and they're incorporating that into stock prices. So stock prices go lower, growth stocks go much lower, value stocks outperform growth.
How much lower for a correction do we need to see before we hit bottom? How do you see that, actually? How do you tell it's bottom?
You don't know. I mean, like, look, if somebody here has the bottom indicator, just my phone number, I'd love to know that, and everybody in this room would love to know that, and everybody who sits in front of a Bloomberg terminal.
You have the crystal ball, Ken, do you not?
I don't have the crystal ball at all. Like, mine is just dark when I look into it. I can't see anything.
Do you have a fund that's actually just net short?
No, we do not have a fund that would be in any meaningful way net short.
Why not?
Over time, we bet on the growth of the American economy.
What does this all mean for active investment? It should have been back.
So active investment drives our equity markets. Drives it. In fact, this is one of the real apprehensions that I have with a number of the SEC's most recent policy proposals, is they are reducing the ability of active managers to deploy capital and to earn the benefits of their research. And the great savings of American retail investors by having access to index funds is predicated on markets that are efficient. Markets are efficient because of active investors. So ironically, one of the great sea changes in our lifetime has been the rise of passive investing. It has saved American households countless tens of billions or hundreds of billions of dollars. I mean, the numbers are staggering numbers. And the SEC, in their effort to make active investing less attractive, I mean, this is like the policies for the equity market that parallel our energy policies of the last 2 years. We got higher prices of gasoline at the pump because of poor decisions out of Washington, and we're about to make our markets less efficient if the SEC's agenda is pursued.
So how would you change the equity market?
The U.S. equity market is unquestionably the envy of the world. It is the single most efficient competitive market in the world, hands down. Now, this doesn't mean there's not room for improvement. I mean, to be clear, it's in a variety of technical details that isn't that interesting. We published plenty of white papers and comment letters on this. I think I'd put the audience to sleep in about 3 to 4 minutes.
Not if you do it in 20 seconds.
Yeah, but I can't do it in 20 seconds because it's just not that interesting, and it's all highly technical. So to be clear, there's room to improve the U.S. stock market. But the most important thing we can do for the U.S. stock market is to ensure that we have a very vibrant and community of active investors that engage in research, price discovery, and commit their capital against what they're doing. That's the most important thing we can do to make our equity market really serve the needs of corporate America and the American public. The other thing we need to do is we need to think about how do we make the American equity market attractive to corporations to be a part of. Yeah. The rise of private equity is really a testament to the difficulties and challenges of being a public company. We should think about how do we have far more companies be public companies where their success is enjoyed by American investors, saving for the retirement or otherwise. And everything that we keep piling onto the list of obligations and responsibilities for a public company discourages that from happening. We've seen thousands of fewer companies in our public markets today than 25 years ago. And that's really, I hate to say it, but shame on Washington for really forcing so many investment opportunities outside of the line of sight of the American investing public.
And so, Ken, you don't think this comes from a place of actually trying to keep more people safe when it comes to public money?
Wow, so if we're going to try to force everybody into T-bills, that hasn't worked so well. The American investor in T-bills over the course of the last 2 years has lost about, ballpark, 15% of their real savings. So I'd call that a really big policy failure if we think safety is everybody in American public has to invest their money in T-bills.
I want to ask about liquidity. Is there going to be a liquidity problem in the markets? And is that one of the biggest concerns that markets are actually not talking about? You know,
I think that people use the word liquidity in a very, loose way, okay? And there's various forms of liquidity that matter to markets in various ways. The biggest challenge we have this year in the market with respect to liquidity is the very low rate of new capital formation. So we're seeing a real dearth of new equity market deals, IPOs. And that's problematic because that's the lifeline of the entire venture capital system, which has been so important to the American growth and productivity story. So fewer IPOs, fewer ability to exit investments for VC firms leaves us short capital to invest in the startups of tomorrow.
But why is that? COVID?
There's a litany of reasons, and part of it is people are dealing, number one, with their losses in their growth stock portfolio. Number two is chaotic market environments become all-consuming with respect to your current portfolio, and you just don't have time to look at new ideas. I mean, on a day like yesterday, if somebody calls and says, hey, we've got this great IPO, you're sitting there going like, I got enough problems on my plate to not talk about a new investment opportunity.
How often do those come up, actually? How often do you make a decision on a new investment opportunity?
How often do I?
Yeah.
Rarely. The people that work for me are much better at most of these decisions than I would ever be.
But how many proposals do you get?
I mean, like proposals, it's like an endless number, but decisions is very few.
How has COVID changed the way you work and how hedge funds work?
You know, that is very mixed across the industry. One of the big changes for us was the lack of access to corporate management teams. We are so intertwined with corporate America in trying to understand business models, the value proposition for consumers, how they're going to take the business forward in terms of new R&D and new projects. Losing that connectivity to corporate America when we went to a world of Zoom-based calls that became very anodyne, that was a big loss, and that was a loss for efficiency in markets. So the last few months have been a wonderful sea change in that we've had so much more connectivity back to the companies that we support and back in understanding how they're going to evolve their businesses. For us, the world post-COVID looks very much like the world pre-COVID. We're all back at work around the world at Citadel, absent a few jurisdictions in Asia. And that collaboration within our four walls, I think, has been an incredibly important part of our success story over the last 2.5 years. It's something that I wish all of corporate America would embrace, because what you see, and there are more and more studies emerging on this, innovation and creativity fall in a remote workforce. And for us, so much of how we create value in one form or another involves creativity and innovation. And having everybody back together has been really powerful in driving forward our overall business.
And it hasn't hurt keeping talent or hiring.
You know what? We lost a handful of people over the course of this journey. Let's be clear. The first 2 or 3 weeks back, for most people, it was like, oh, I can't believe they made me come back to work. And then in December, when we saw Omicron reaccelerate, we told everybody on December 14th, go home for the holidays. Like, this wave was going to sweep across the United States. We'd had an outstanding year. Everyone had given it 110%, and most people kept coming to work. So what it's really a statement about is we're creatures of habit. And we create new habits pretty quickly. And when your habits turn back into, I go to work, you start to say things like, I actually enjoy the separation of my personal life and my professional life. I mean, I can't tell you how my colleagues are like, it's actually really nice to be in a room and not have to deal with like managing 25 different distractions at home. So I think most importantly, we're creatures of habit, whatever those habits may turn out to be. But for us, the chance to collaborate, the chance to work together, the chance, there's been so many meetings over the last 2.5 years in front of whiteboards with new insights, new concepts. That would never have happened in a Zoom-based world.
Citadel has made money when a lot of people haven't. What's your secret sauce?
Look, I think I just spoke about the most important one. It's the fact that we work together as a team.
Everybody says that. What's your real secret sauce?
No, it's really simple. Many of the best people in the world of finance work at Citadel. And they work together at Citadel. And they work together at Citadel in a very powerful way, both from a research perspective, from understanding what the comparative advantage is, from being disciplined. We talked about decision-making. We're very good at pushing decision-making through the organization. I have a very simple principle. The most junior person who is qualified to make the decision should make it.